All right, so a minor uptick coming in for global growth. Meanwhile, for growth projections as far as India is concerned, that remains unchanged. And of course, the IMF is calling India the fastest growing major economy. Ladies and gentlemen, the big question then is, can the current growth rates be sustained? Well, to discuss that and more, I'm now joined by Devendra Pant, who's the chief economist at India Ratings. Also joining us is a very special guest, Swaminathan Iyer, consulting editor of ET Now. Gentlemen, thank you very much for joining us here live on this broadcast. Let me come to you, Swami sir, first. Now, policy uncertainty due to tariffs, that seems to be the big takeaway if you heard and listened to that press conference. But how does the data for India look to you vis-a-vis its peers and, of course, these Western countries that the IMF mentioned?
Look, all that the IMF is saying is things are not looking as bad as they looked in April. Still, if you remember, there was a higher estimate of 6.5, which came down to 6.2 and is now up to 6.4, which is still down. But this is a highly provisional estimate. The truth is, we do not know what is going to happen in the USA under Mr. Trump on the supposed August 1st deadline. Some people say August 1st will be followed by a September 1st deadline, will be followed by an October 1st deadline, and that Trump always chickens out. There are a large number of uncertainties, although it does appear that whatever may happen, we are not going to have those crazily high duties initially suggested. Nevertheless, the kind of increase in that we're going to see, especially in areas like steel and aluminum and in autos, I think would be very considerable. We have to wait and see how this game plays out. In the first quarter, things have been surprisingly benign. The major reason, of course, is that many of the proposed tariffs have been put off. So the kind of slowdown you expected has not taken place. Secondly, it is also quite clear that Trump is right in saying that the United States has a monopsony. It has a huge purchasing power, and it can exercise this purchasing power to demand a lower price from other people through the higher tariffs that it has imposed. And it has getting away with that, and there appears to be very little slowing of its own growth, but they're going to get $300 billion in import revenue if this trend continues. So, things have not been as bad at all for the USA. The stock markets in general are saying, forget about current negotiations and Mr. Trump. We will look through all this to the longer term trends, which look to us fairly favorable. We will come back to the tariffs issue after two things. First, because there was a lot of stockpiling of goods in America immediately after Trump's victory, because they said, tariffs are going to go up. So lots of people started buying inventories at cheap prices, saying they will go up after Mr. Trump comes in. Now, that inventory effect will play out after maybe 6-7 months. Till then, because of the high inventories at low prices, the inflationary impact on the USA, the rest of the world is less. But as the months go by, I think gradually you will find the impact of the tariffs getting higher and higher. The inflation in the USA will become higher and higher. What you may see in the form of Chinese dumping of goods that they cannot sell to USA, that may get worse and worse. So there are a large number of unknowns right now. I think the markets are looking through this right now, saying, we will cross that bridge when we come to it. But at this point, the one thing that we can say is that things look better in July than they looked in April. So that is an unquestionable yes. So, okay, for now, things are not turning out as bad as we thought, but wait and watch. There are many, many dangers on this path.
Right, sir. So it's fair enough to say, like you put that into context with your opening remark, it looks better than what was expected, but rightly so. We'll have to play the waiting game to see how that's going to pan out. We'll talk about that further. But Mr. Pant, thank you also for patiently waiting to perhaps look at the way you're looking at this, because like we put that into perspective, given the fact that India's 6.4% forecast comes with the IMF's caveat as well, and that given the fact that they pointed out is the upgrade of the external environment driven. So is that in a sense warning that without structural reform acceleration, this number is not self-sustaining?
Well, you're right. We can get advantage of when the things going is good across the globe. We are talking too much about 2.8 global GDP growth going up to 3.4 or 3%. But what matters most is how the global trade volumes are growing. So if we go back to 2003 to 2008-9 period, that time the global trade growth, and I'm talking about goods, I'm not talking about services, volume growth was in excess or in multiples of the global GDP growth. Right now, the situation is, let's take 3% IMF growth forecast. This is lower than the historical average of 2000 to 2019 of 3.7%. So the global economy is growing much slower. Even earlier April, it was 2.8, and went up to 3 now. In January, it was 3.3. So we have journey from 3.3 to 2.8 to 3. But even 3.3 was lower than the long-term 20-year average. So this means the global economy itself was slowing down. This is point number one. The point number two is, if we look at how the trade volumes are growing. Now, if I look at the World Bank came out with the forecast in the month of June, the global trade volume, goods and non-factor services, is forecasted to grow at 1.8% only. And World Bank's forecast in January was 3.1%. 2024, it was 3.4%. So World Bank expects June and July not much different. There'll always be a difference of 10, 20 basis point here and there in the growth estimate by any organization. Like we are at 6.3 for India. IMF was at 6.2, now they're at 6.4. We are looking at trade growth volume slowing down to again nearly half of what 2024. So the external environment is too hostile for
Absolutely.
us. Now, in that situation, because see, we can't go and create demand in other economies. What we can do is how we can make best use of resources and create the policies which are conducive for growth within India. Now, if you look at what is happening to the investment growth and what is happening to the consumption growth, both are faltering.
Right. Right, Mr. Pant. So this is essentially a point that was also brought about by Swami sir as well when he mentioned that as far as exports growth is concerned, in fact, there's a lot of stockpiling of goods that is happening in anticipation what's to come on August 1, and that will perhaps decide the trajectory of growth that the world and of course India is going to undertake. But Swami sir, let me come back to the point about global growth projections. In fact, the IMF's projections are not very different from RBI's growth projections, which had mentioned that GDP is expected to grow from 6.2% to 6.5% within that range. But how do you look at the quality of this growth, and is this growth percentage enough?
Look, everybody is agreeing that India is a highly resilient economy, which has taken so many shocks in its stride that whatever is happening, it is a shock. There is a Trump shock. But the expectation is that a country that, went through COVID and went through the post-COVID things. I mean, I always keep repeating, 2023, it was called The World is on Fire. This was what Larry Summers said. And the revised figure for India in that year is 9.2%. So when the rest of the world was burning, India did 9.2. So there is no question that when conditions are bad and all our neighbors had to run to the IMF for help, India did so well. So India, there are a lot of very fundamentals which are clicking for India right now. That means that no matter what happens, India should be able to do quite well. The world economic outlook, overall asset, it may have improved compared with April, but overall the outlook is certainly slower than it used to be, as was said by Mr. Pant. The world is nowhere near like the euphoric things that we had from 2022, from 2000 to 2020, when things were much better. Of course, remember, China in those days was growing in double digits. Now it's down to 4% to 5%. In all I can say is yes, so the whole world thing has slowed down. India has shown itself to be an exceptional performer. But I would add that please let us not take these projections so seriously and going into each decimal point, because every quarter these things will be revised. We have no idea at this point why exactly US tariffs are going to end. We have very little idea of to what extent exporters will be able to absorb uh, the effects of the Trump tariffs, to what extent they will be passed on and thus cause inflation. If that happens, will it then result in an American slowdown, an American recession even? Will it then lead to very bad midterm election for the congressional elections in the USA, which will blunt Mr. Trump? Or on the other hand, will he get away with it and will he then continue further and further? You see, once upon a time, people used to say that a US president is not very, very effective in his last 2 years. But we have a new situation where we have a president doing everything by executive order. This was never happened done before. Earlier, you had to get congressional approval, other people's approval. This guy just says every damn thing is an emergency, and under an emergency, I can do anything. I think we are also going to see the courts restraining Mr. Trump in various ways.
Right.
Sorry.
Absolutely, sir. Whether these moves are sustainable is something that we'll have to see. But Swami, sir, let me ask you one follow-up question before we come to you, Mr. Pant. Swami, sir, you mentioned a lot hinges on how August 1 is going to play out. So what kind of disruptions are you anticipating specifically in the India context post-August 1? Are you anticipating that there's going to be a mini deal perhaps that could be signed, or are you anticipating perhaps a tariff in the range of perhaps 10 to 15% which will come into effect?
I will say this. I think we have been underestimating India's growth potential. If you take the average of the last 2 years ago when we did 9.2%, this was ascribed to the fact that there was an unnaturally low GDP deflator. But that should have worked the other way the next year when you got 6.5. The average for the 2 years became 7.85. Now, if you are doing 7.85 when the world is on fire, something very positive is going for you. So the kind of 6.4, 6.5, I think the outlook, if the outlook is as good as the IMF thinks, then I think the India may exceed that 6.5. And on the other hand, if things get much worse, as I think is more likely, then India may still be able to exceed 6.5. That would be my broad assessment, given how well India has been able to do in this particular environment. Because those new fundamentals, just look, the macroeconomics, the fiscal deficit is well within control. The current account deficit is virtually zero. Inflation is down to what? 2.1%, so low. Wholesale price index is negative territory. So your overall macro fundamentals are so strong at a time when other countries are doing badly. It's very clear that India has some very solid underlying trends which are going to preserve it. And I hope we will be able to exceed that target of 6.4.
Right, so in fact, as you put that into perspective and like what you initially spoke about, given how the story is still resilient for India despite those external shocks as well. So let me take that point across to Mr. Pant. Mr. Pant, given what Swami sir also did point out, and India's growth story in fact rests heavily on public capex. But if fiscal deficits are forced higher by external shocks like we were discussing, do you see the center recalibrating infrastructure spending?
Look, the central government or the union government or the state government or the government capex can lift up overall spending or the overall investment in the economy to a certain extent. Because if you look at what is the proportion of government capex in overall capex, it's hardly 15%. If I add public sector also into it, it is 1/4 of the total. Now, both central and state government has a fiscal constraint. Now, either if the capex spend has to go up, then the revenue expense or the expenditure has to be cut down somewhere else. Now, where it will be cut, the reduction or the will take place. You have subsidy bill to pay, you have pension to be paid, you have interest payment to be paid, you have salaries to be paid. Now, if I take just these four components on the revenue expenditure side, or so to say in corporate terms, the current expenditure side, they take roughly 2/3 to 3/4 of the overall current expenditure or the revenue expenditure. So in India, whatever fiscal correction we see has to come from the revenue side. Now, we are looking at a situation this year, whatever data we have, now the data is very limited, it will be not correct to draw conclusion based on couple of months data. The direct taxes growth, which has been phenomenal in past couple of years, is now lagging, and it is lagging. It is lower than the budget estimates. Now, the entire onus is on the indirect taxes, and all of us know if the indirect taxes have a larger proportion in the overall taxation, it is regressive, because when it comes to the direct taxes, which is the corporate tax and income tax, government is taxing people like V4 in this program. But when it taxes the indirect taxes proportion goes high, even a street vendor, a rickshaw puller is subject to that taxation. Now, from where this additional source of revenue will come so as to spend on the infra? Now, let's talk about infra. You have the great success story in the name or in the road construction, which of late, if you see last couple of years, is slowly slowing down. We have tremendous run in the renewable. Yes, that is continuing, and expectations are that will continue. So we have to quote unquote, it's very easy to say like government should increase the capex just before the budget, every commentator, and will say, no, let the government come and unleash the animal spirit. Yes, by all means unleash, but where? That is the question. If the money is there first, where is money is there? Yes, money is there. Now, which sector to be spent? Because most of this spend is to be done by the state governments. Because when you talk about health, you talk about education,
Absolutely,
you talk
sir.
about the roads,
Absolutely.
all of this in the
Absolutely. And this is something, Mr. Pant, I'm afraid I have to interject here, because this is something that has come up in GST Council meetings as well. So definitely a policy push is required, even as India remains a robust economy. In fact, it has remained resilient to external shocks. Let me come to you, Swami, sir. Now, let's talk about the world and particularly China. The IMF has raised China's growth forecast as well. But given the fact that China is largely an export-based economy, and it could be perhaps at the risk of another trade war with the United States, is that projection that the IMF is giving, is that at the risk of being revised?
I think the first thing I have to mention, and people don't know this, is that as a proportion of GDP, India's trade is higher than that of China. So yes, it exports a huge amount because GDP is 4 to 5 times higher than us. But you'd be surprised that, just as trade, we are, to that extent, India is more interconnected than China is. On the other hand, India doesn't have the Chinese problem that capacities are being built with subsidies from provincial governments in China, saying, there will always be an infinite demand from the world market. And that infinite demand has dried up. This game worked very well for 20 years. Now you have run out. When you are already producing 200% of the world demand for solar panels, what is the point of having more provincial governments encouraging even more investment, even more production, as they have been doing in the last year? So China is in some difficulty on the entire trade side. It's very difficult overall to see what is going to happen. The Chinese Xi Jinping, as of now, I think he has paid attention to the fact of chronic overproduction and of too much subsidies from the provincial governments. At the same time, he's unwilling to really back off and say we have been doing the wrong thing. And we need to completely change, because if he does that, it will mean that large sectors to which loans have been given are going to get sick. I saw a recent article on how the proportion of profitability of Chinese companies is steadily falling, because the formula that worked in the old days, that you just set up huge capacities and export the surplus, that is no longer working, and they're going to be in some trouble. That is dragging down the entire world economy, I would say, in the post-2020. And that is one reason why Mr. Pant says that, we are growing much more slowly. Yes. And a major reason for that is that China is growing more slowly. Sorry, I have wandered wide and far. I hope that's I've answered.
Right, Swami sir, you did. But let me take that point also across to Mr. Pant, given we're speaking about the China aspect. And Mr. Pant, China's upgrade to 4.8% for 2025 is significant, but domestic demand, we understand, is still weak. So how should India, in your opinion, read this? Is it an export opportunity or a signal that China remains a volatile variable?
Look, if I was looking at Chinese trade data for past 2 months, and despite all the tariff and other things, Chinese exports to US has went up by 30%, I think, in the month of April. In the month of May or June, it came down to growth was around 15%. I don't think we have seen that 15% kind of trade growth in India, goods trade growth in a long time. So China will always be an external demand story, and India will always be an internal demand story. And both countries will try to maximize gain. If I look at it in the game theory form, they will try to maximize gain wherever they have the edge. Like India is maximizing its gain on the services export. Very few people talk about it. And this year we are expecting, say, somewhere around $200 billion kind of surplus on services export from net services export from India. So yes, if we look at if the China is continuing to grow, and the more demand is coming from more growth is coming from the external sector by the trade, and we are not able to capture it, then this means there's something wrong. And we have to find out what are the reasons why we are not able to do it and how quickly we can fix those. When I say fix those, it's not a quick fix band-aid solution, but do a long-term solution whereby the Indian entrepreneur or Indian exporters takes advantage of that and become a part of global value chain.
All right. Thank you very much, gentlemen, for joining us here on ET Now on India Tonight and sharing your perspectives on what IMF's projections really mean for India, the world, and, of course, India's neighbors, including China, and whether the China Plus One opportunity is something that India can capitalize on. Thank you very much once again for joining us, gentlemen.